Welcome to Vida's Real Estate Learning Videos, brought to you by Vida Real Properties and Services, where you can find us at rentandbuyhome.com and vidarealpropertiesandservices.com. Today we're going to be talking about LTV and MI. So let's go ahead and get started. So let's start with LTV. That stands for loan to value. Okay, so really what we're talking about is the mortgage on your home divided by the value of the home. And that's going to be expressed in a percentage. So when you're buying, obviously this is going to be the amount of the loan divided by the price of the home. So for example, on an FHA loan, they're going to lend you up to 96.5%. So that's the LTV. On a conventional loan, it may be different. The minimum may be a 5% down payment required, so the LTV will be 95%. So we're talking about the relationship between loan to value and mortgage insurance. So the idea is that the more down payment you have, the less need for mortgage insurance. However, and we're going to look at your standard FHA loan and conventional loan. FHA has made it more difficult here since 2013 to get rid of the mortgage insurance. I'm going to put up here a little chart. So I'm going to go back here to conventional. On conventional, you can get any kind of program right now with, if it's 2%, 5%, 10%, if right off the bat you put 20% down so that you have an 80% loan to value loan, you don't need mortgage insurance. Okay, you don't have to pay that. So obviously that saves you on your monthly payment, but you are putting 20% down payment. If you get a conventional loan and you put 5% down, but then with time the value of the property goes up and the mortgage goes down, if you get to 80% and you have to get an appraisal and show the lender, you can drop the MI. Or if the property drops to 78% loan to value and that comes from the lender, they drop it. Okay, so you can get rid of the mortgage insurance eventually depending on either of these situations. So now we go back to FHA, and basically the best way to describe that is to bring up this chart right here, which you can find at this website. And you can just look at FHA.com, HUD.gov, and look at, search for mortgage insurance requirements, and you're actually going to find something like this. So obviously here we're looking at less than 15 years on the term of the loan. On a 30-year mortgage, which is going to be your more standard, these are the requirements. This is what, again, we're looking at the LTV, so now you're an expert on that. This is what it used to be, and then these are the new requirements. So now, for example, here you could have had it canceled at 78%, now 11 years. The loan term basically means the life of the loan. If you have over 90% loan to value, it stays there. And this is when you get the purchase. So the loan term is basically the life of the loan. So the only exception in FHA on a 30-year mortgage is if right off the bat you put enough down, but you still have to wait 11 years before you can cancel the mortgage insurance. So, this is just a summary of comparing loan to value and mortgage insurance. Some simple requirements, what they mean, how that affects your down payment. You do want to talk to your lender and discuss further on both of those topics, because it is important, and it is affecting your monthly budget. And you want to know that if you're able to qualify for a conventional loan, that just for the fact of being able to drop the insurance eventually, as I mentioned here, that may be worth it, and only get a loan with FHA if you have basically no choice, and that's your only way to get a loan. You can also refinance eventually into conventional loan, but obviously there's fees to refinance. Both the LTV and MI are important parts of your financing. Hope you know a little more about them now. Thank you for watching. Make sure to subscribe to see other Vida's real estate learning videos, and always check out the resource links in the About section.